Well, hello everyone. It's Michael again with MPK Advisors and CPAs. Thanks for joining us for part two of our series, Standard versus Itemized Deductions. Again, this is meant to be educational, and if you do require or desire specific tax advice, we'd be glad to set a consultation with you and discuss some of your questions. But this part two will be going over some of the other itemized deductions that we didn't cover in our first part. Again, as a reminder, standard versus itemized deductions. The standard deduction is basically a freebie. It's a given flat amount based on your filing status. And so as a reminder again, for 2024 year, the standard deduction was $14,600 for a single filer and $29,200 for married filing joint. So if your deductions, you tally those at the federal level, and they are not more than that based on your filing status, you would take standard deduction. If they are, you may be eligible to itemize and claim all those deductions. It's the greater of the two. All right, so we'll jump into the interest deductions. And the last session we covered the state and local income tax deductions and the medical deductions. Today we'll be covering interest, charitable, and other miscellaneous. For the interest deductions, typically the biggest one there is your home mortgage interest. And this concerns any interest on mortgages that are secured to your main home or a second home. So if you have, typically people have a main home in which they're living and it's secured by a loan, that is a mortgage. And so that interest is typically deductible. Now you have to be careful because if you refinance and pull cash out of the mortgage, the new mortgage, that cash, if it doesn't go back into the main home to either build or make better the main home and you use it for other purposes, your interest may be limited on that loan as far as deductibility because you did not use those funds to go back into the main home. So please discuss, if you have questions, discuss that with us. We'd be glad to help answer those questions and figure out what the deductible portion would be if you have that scenario. So, but typically if you have a main home, you purchased the home, you acquired a mortgage on that home and you haven't refinanced, usually all that mortgage interest is deductible. And they'll give you that on a form 1098, it's called, from the mortgage servicer. And if you have your property taxes impounded in there, they'll also give you your property tax paid amounts on that form. Some other types of interest that are deductible are investment interest. That is anything that you incur on loan interest potentially on an investment property. Maybe you have a second home that you don't live in and it's out of state. That would be considered an investment home, and that interest may be deductible. However, it's limited to investment income each year, or else it carries forward. So just be aware of that. So those are the two most common types of interest deductions that we see. We'll move on from there to charitable contributions. So there's two main types of charitable contributions. You have cash contributions and non-cash type contributions. Your cash contributions include all those contributions to eligible charitable organizations, and those are usually those organizations within 501c3 of the IRS code. So you want to make sure on your giving statement that the charity discloses that they are a 501c3 and that your donations are deductible to ensure that all those contributions are truly deductible. And those would go on Schedule A as well. So that include cash, check, or online merchant contributions through credit card as well. You could deduct all those. And typically charities will mail you at the end of the year in January, beginning of the new year, for the prior year, all your deductible contributions. Some of the non-cash contributions may include your donations like clothing or household goods. Always a great time in spring cleaning. You clean out the garage or the bedroom and just donate a bunch of shoes, clothes, that sort of thing. That would be deductible as well. And I always encourage people to save the receipts because it can add up to quite a bit of extra deduction. So I encourage you to save those receipts. But when you save those receipts, make sure to include the date of your donation, a short description of the items that you donated, and make sure the charity that you donated to is listed on that receipt as well. And also, and this is important, we want to estimate the fair market value of those items when you donated them. Typically, people will use thrift shop value as a benchmark. What would they sell these items at a thrift shop for? So you want to make sure those components are on those receipts. That'll help your tax preparers. Thank you to do that, and do it without too much back and forth conversation with you. Some other types of non-cash contributions include volunteer expenses. So say you volunteer for a charity and you went out and bought some supplies or other items for an event, and you were not reimbursed by the charity, you can claim those as volunteer expenses under your charitable contributions, as well as driving miles. So say you drove to and from an event and volunteered, you can also claim those miles. So please save those also. The last category is other miscellaneous itemized deductions. So unfortunately, the 2018 Tax Cuts and Jobs Act suspended these at the federal level. So we no longer have these at the federal level. However, at the state level, most states still retain these. And California, if you're in California, California does not conform to the federal rules on this, and so we still get miscellaneous itemized deductions. And the most common miscellaneous deductions are employee unreimbursed out-of-pocket expenses. So those could include things that you had to purchase for your job that were not reimbursed and were required. Some other things could include things like driving miles as well for an employer or a job where you were not reimbursed, or even home office expenses that you incurred and were not reimbursed. So those are some examples. You can also deduct your tax preparation fees that you paid in the prior year that under miscellaneous itemized deductions. So you do get that benefit at the state level potentially if your state did not conform to the federal suspensions, but otherwise you do not get those deductions any longer at the federal level. We hope this has been informative for you, series on standard versus itemized deductions, and we look forward to updating you more in the future as we're also preparing for other topics to deliver. Appreciate your time.